Hi, my name is Gary Munson. I am a co-founder of Main Street Alternative Asset Planners. I'm excited about the time we're going to spend talking about how we help people jailbreak their IRA and 401k long-term savings type assets away from the risk of the Wall Street casino. I just don't believe that the reward is there anymore on Wall Street to offset the risks that are there available to it. And so we've seen the writing on the wall, and we've prepared a fantastic basket of assets that are a great alternative to being right there on Wall Street. So let's go in and talk about it. Today I saw an article in the paper that talked about how this particular analyst felt like the market was way overvalued and due for a correction. And I'm not here to alarm people, but I do know for a fact that the baby boomers are leaving the workforce. They're starting to retire. And as they do that, they, of course, are drawing their money away from the market. And, when money's going out, the market will fall. But not to mention that, there's things that have taken 35% of our values over the last couple of years, and man, people are just not happy with what's happening on Wall Street. What we like to point out is that the cost of losses are much worse than the benefits you gain from an up market. Let me take a look here at a hypothetical account balance. Could be a mutual fund. It could be an individual stock. But let's just say someone started with $100,000. In the first year, they lost 50%. The second year, they had to do a double of that. They had to get 100% just to get back to zero, back to where they started. And then in year three, another bad loss. In year four, another fantastic up market. Well, at the end of the 4 years, it's interesting. They're back to zero. The crazy thing about it, though, is the fund or the stock can show an average return of 25%. And who wouldn't take a 25% average return? But the amazing thing about it is you look at this, great average returns don't always grow your account. And I've talked to numerous people that tell me this is their stock portfolio back since 2001. So over the last decade, this is what's happening. Well, we want to help because people feel frustrated, they feel misled, and Wall Street and their magic math is something that we don't want to be a part of, and that's why we're jailbreaking dollars away from Wall Street. A lot of people we've talked to have given up on retiring. They've lost so much principal that they just don't see them earning enough before they needed to retire to have the money to generate their retirement income. So they've kind of run up the flag on the 401k. We know the stock market's taken back 35% of account values 2 different times in the last 5 years. People are frustrated. They want something else. They're looking for other things. Well, here's a chart that talks about what's happened on the stock market. And it shows 10-year rates of return, starts the first day of trading in any decade, and then charts the last day of trading on any decade, and just measured what the Dow Jones Industrial Average did. And the tan lines are when the market stayed above inflation. The white are when it didn't. And let's just look at the last 50 years to find relevance. Let's go to 1960s, 1.65 in the 60s, 0.37 in the 70s. Now, the 80s and the 90s were kind of an anomaly. What we had there was the baby boomers just plowing every extra dollar they had into something new called an IRA or a 401k. These are new retirement accounts the government had created for their use. And the stock market seemed like a great place. And there were so many of them pushing it in there. We also had some tech stock booms and the dot-com boom, and it really rewarded the baby boomers putting their money in there. And it kind of gave the types of returns that we would hope we'd get in the stock market, 12.8, 15.3. Wow, that'd be great. I just don't think we're going to see that again, because when people are buying things and there's a demand, prices go up. Well, now the baby boomers, I'm told in the next couple of years, are going to start turning 70 and a half. And that's when they got to start pulling money out of their IRAs and 401ks. So that money's going to start coming out. The other end of the baby boomers, well, they're turning 65. Turning 55 and 60, and these guys are starting to draw their money out. And so again, as people are pulling money out, there has to be a buyer, and so the values will drop and the prices will go down. Not to mention the people who are tired of losing their money. So there's all kinds of people taking money out. I just don't see a sustained growth situation like that. The 2000s were minus half. What's it going to be in the 2010s? And are we ever going to see 12% again in the stock market? I don't believe we will. Certainly not 2 decades in a row. Well, A lot of people I talk to have got their money out of the market because they know they don't want to be in the risks of Wall Street, but they've got enough of that, but they're trying to keep their principal intact, and so they've moved their money into a cash account like a money market or a CD, just to kind of keep on hold of something, keep some principal intact. And what they need to understand is there is a cost to inflation, but it seems like the better risk than losing your shirt entirely. Well, we like to talk to people about what the effects of inflation are because we believe that there's a big kind of a jump in inflation coming. Some will call it hyperinflation. But what happens in inflation is when there's too many dollars chasing the same amount of stuff that's available. And so prices just go up. We see Washington making some big commitments to social programs and government programs that are just going to require those printing presses to just keep running, to keep up, to fund all these programs. Now, 6% inflation, and I believe it's higher than that, but if we look back 30 years, we can show it was at least 6. If we had 6% going forward, if my teenager wanted a pair of those $200 jeans and she waited another 2 years to buy another pair, it'd be $225 because there's, again, more dollars chasing the same amount of stuff. Well, let's talk just a bit about the effects of inflation. In 1971, Nixon took us off the gold standard, meaning that there was no longer $1 of gold for every dollar of our currency in the market. And so at that point in time, we started to lose the purchasing power. You can see a significant decline from 1971 to 1981, that big tear of the dollar, where in 1981, what that says is it took $1 to buy 40 cents worth of stuff just 10 years earlier in 1971. Now, it's interesting as you look at the red line going up from left to right, that's a measure of the number of dollars in circulation in the billions. And so you see as that goes up, the purchasing power, of course, is going down. Today, this is showing 2009, 2010. $1 buys 20 cents worth of stuff back in 1971. $1's not worth much anymore. You can't even get a candy bar or a pack of gum. It's crazy. We're losing our purchasing power, and this is based on a measurement the Department of Labor has called the CPI. And the CPI doesn't even include energy costs in there. And you can do some magic math with what inflation has done. You can substitute out things, and really inflation is much higher than what they're reporting. But really what matters to you is what is your personal inflation rate? What are the things that you buy doing? Because I know when I go to get a gallon of gas 2 years ago, I could get about twice the gas I get for my money right now. What does it cost for me to go buy a candy bar or go to a movie or go buy some clothes or some milk at the store? And that's really what matters, is what's happening to the prices of things that we buy. And I know for me, prices are going up. So we've got to factor that in the future. We like to talk to people about how money grows. Albert Einstein was quoted to say he thought the greatest miracle of the 20th century was compounding interest. And we'd like to show people how does compounding interest works. Because I will say this, the people who know how compounding interest works earn it. Those who don't know how it works, they pay it. So I'd like to give you some insight about how that works to make sure you're always on the earning end and not the paying end, because you'd be too shocked if you were paying it. But we use something called the Rule of 72, which is a real simple way that's remarkably close to using a financial calculator to see how money grows. And what the Rule of 72 says is you take any interest rate that you're considering, you divide it into 72, and the answer is the number of years it takes money to double at that interest rate. For instance, if we were looking at 6%, assuming that inflation continued at 6%, every 12 years, money will double. So dividing 6 into 72, the answer is 12. So that means today, if my budget was $5,000 to run my household, going out 6 years, it's fine. At year 12, it's going to cost me $10,000 to buy that same amount of stuff. Well, let it roll out 24 more years, and it's going to cost me $20,000 a month to buy the same amount of stuff that it cost me today to buy for $5,000. And so we've got to keep that in mind as we're preparing for our retirement time, because the longer we wait, the more it's going to cost just to live. Well, what if we looked at 12%? We divide 12 into 72, and that answer is 6. And so if we had money doubling at 12%, we're going to have a double every 6 years. So this is where we want to be at having our money growing. And I've got some insight into how you can gather 12% on a fixed type of a return. We've got these kind of assets available, but I don't want to let the cat out of the bag too soon. So let's just look at how that works. In 6 years, our 10 grand growing would double to 20. And then at 12 years, that would double again to 40,000. And then at year 18, it would double once again to $80,000. And then at year 24, that money doubles to one more time and ends at $160,000. Now, I love money compounding and growing at that great rate of return. Now, it's interesting, the banks can get 18% on our credit cards. And let's just see what that does. 18 into 72 is 4. So that means the sum of money the bank's lending out on credit cards is going to double every 4 years. And let's just see what happens, because what happens is if we in our accounts can safely fight to get one more double, what does that do for our standard of living during our retirement years? You're exactly right. It doubles it. So that's a very big deal to get a double. But let's look and just see what that happens. 10,000 in 4 years doubles to 20. At year 8, it doubles to 40,000. Once again, at year 12, we double once again to 80,000. And so the difference between 12 and 18% over 12 years is just one double. And let's look and see what happens at year 16. It doubles one more time. Year 20, we're at 320,000, and at year 24, we're at $640,000. So what I want you to take away from this is if you could find one more double somehow by improving and increasing your rates of return, all it's going to do is double your standard of living. What if you got two more doubles like you got there at 18 and 12 there? Just squeezing in a couple more doubles, man, it makes all the difference. And this is what we show people how to do. Well, a lot of the folks we talk about, since their money is locked up in an IRA or a 401k or maybe some sort of a SEP program, and they've probably moved that money out of the stock market and into these money market or CD type of accounts, some people have just kind of given up on it. They can't touch it because there's penalties and taxes that they'd incur, and they can't invest it anywhere else. And so it's just sitting there. It's dead to them. Well, sometimes people are frustrated because they've got friends that are getting great returns investing in opportunities that you can't. Maybe do some hard money loans and get some great returns on that. Or maybe go buy a foreclosure and flip it. Or invest in a great business. Maybe you have a family member that's starting up the right thing. Or go buy a franchise, a sandwich franchise, if you want to. But, we've got the media that starts to see that people want some other options besides the stock market, besides the mutual fund list that your big brokerage house allows you to invest in, or the money market account. This is a Wall Street Journal article from March the 2nd, 2012. IRAs get sexier. And this is talking all about Mitt Romney's self-directed IRA, which is what we're talking about, self-directed IRAs. His has $100 million in it. And you want to guess how much of that is in a mutual fund? None of it. But the media sees this, and many people will say to me, Gary, I didn't know that you could invest anywhere besides the stock market or mutual funds. And absolutely you can. When Congress started these retirement plans, they allowed them to go anywhere. Just most people put them in the stock market. There it says, although IRAs have been allowed to hold a variety of assets since 1974, investors have opted for those conventional stocks and bonds during the bull market of the 80s and the 90s, because that was easy money at the time. Well, what we've got is lots of money in alternative, or that needs to go to alternative assets. But it's interesting. This same article said $4.6 trillion are held in IRAs, and just 2 to 5% are in alternative assets. That's a teeny slice of a massive pie. How big is that pie? Well, $4.6 trillion is just the value of the 25 largest U.S. companies combined, starting with Apple and ExxonMobil and stopping at Amazon. And you're incorporating Google and Chevron and Coke, Procter & Gamble and Philip Morris, and massive companies. That is a lot of money that's sitting in the market. And I'm told, by the way, more money's in these cash accounts like the CD in the bank or the money market account that's actually invested in the stocks. So there's money sitting there that wants to go somewhere, but it's just not there yet. In fact, this is the article that tells me this money wants to go somewhere. This is financialplanning.com. They quoted a survey done in February where they went out and asked 1,000 people if they knew what an IRA was. And here's what they asked them. If you knew what an IRA was, they said, how would you like to invest your money in alternative assets? And a significant portion, 3 out of 4, wanted that. In fact, it said Investors are interested in putting a portion of their IRAs towards alternative assets, but often lack the know-how and the advisors to do so. And then it went on to say 77%, more than 3 out of 4 with retirement accounts, wanted to invest in alternative assets, but didn't know how to achieve that goal. You'd think you'd go get that from your financial advisor. Well, the same survey asked 365 financial advisors about it. And 83% of the clients had expressed interest in investing in alternative assets, but only 10% said that they had clients who had invested in alternative assets. So 83% of them had been asked, only 10% could say yes. 90% of them turning that down because that's the way the securities laws work. They can only sell the mutual funds and stocks that are on their list. So they can't go invest in a great run of real estate or go buy some gold or some silver. In fact, this was Kiyosaki research in February of 2012. So we know people want to move their money, 3 out of 4. There's 5.6 trillion that wants to move, and these people don't know where to go get it. Well, what we do is we help people jailbreak their IRA or 401k, get the money out of the Wall Street casino. And it's a pretty simple conversion if people just knew about it and knew how to do it. We convert their account status to allow access for all opportunities in alternative assets. In fact, we've got people who have money that's not in retirement stuff like your 401k or IRA that still want to go get better returns, safer, in kind of tangible assets. But of course, we can do this as a transfer, as if you were moving your money from Fidelity to Charles Schwab. There's no taxes. There's no penalty. We do it all, straight on the up and up. Again, completely legal since 1974. Well, what are alternative assets? What are these things that we're showing people? These are assets that hand control of your long-term savings back to you. I promise you, no one cares more about your money than you. These are assets that create cash flow because that's the only way that you'll ever have the opportunity to stop working is if you have the cash flow to float your budget. And if you're using stocks or mutual funds, the only way you're going to get your money out of a mutual fund is to sell it. Well, we want assets that are tangible goods, not paper assets like Wall Street stuff. We like things like houses that can't be lost. Value can't be lost in a bad afternoon of trading because something triggered weird in Greece. We want assets that protect against inflation because we believe there is some inflation looming because of those printing presses that just keep going. Well, this is also what we like to help people understand is we want them to build assets that kind of act like a golden goose, to lay these golden eggs every single month. I loved as a kid the Jack and the Beanstalk story and that golden goose that would lay an egg that could be used for anything. Then the next day, there's another one there and another one there. Well, assets, according to Robert Kiyosaki, the author of Rich Dad, Poor Dad, is anything that creates cash flow. If your house doesn't create cash flow, technically it's not an asset. So we want to help people buy these quote unquote assets that are going to create next month another amazing golden egg. And so as you look around online, you'll find that people are rushing to own hard assets or tangible assets, things that are real. And again, things that the stock market can't rob our value from. Things like residential real estate, rental properties, things like precious metals, things like private lending, trust deeds and mortgages that are secured on tangible things like properties, real estate properties, and then structured settlements, which is, cash flow. And these are what we call our core four. These are our 4 cornerstones to a solid alternative asset portfolio. And again, we want dividends. We want mailbox money. Passive income streams that are going to be there, that are going to create retirement for us. And again, if we're just able to live off the interest, we can pass these income generating assets on to the next generation, on to our favorite charity, whatever we want. So when monthly rent is in our mailbox every month, mortgage payments from loans we've made are in our mailbox every month, structured settlement payments every month. And we'll talk just a little bit about each of those so you understand what we're talking about. Okay, everyone loves to hear what Warren Buffett has to say. One of the richest men on the planet, and he was recently on a CNBC interview, and he said this: "I'd buy up a couple 100,000 single-family homes if it were practical to do so, if he knew how to manage them and take care of them." He felt like as low as mortgages are right now and as high as rents are, this would be a great asset class. And we totally agree. In fact, we have a way to take care of it. We have a practical way to make this available. And we have what we call real estate packages. And what we do is we find a local market that is ready and a good place to buy, where we've got some vast differential employment. So not Vegas, not Detroit, that are driven by one industry, but a place like Atlanta, where there's 10 Fortune 500 companies. And if Delta Airlines goes out of business, there's plenty of work at UPS or Coke. So we like these great markets that have employers for our tenants to have jobs. And then we go in and we provide these real estate packages. And in the package is a property that has already been bought at a foreclosure auction. It's already been rehabbed and brought back up to nice rental quality standards. And then they go and find a great tenant in place that has a long-term lease, and then they find a great property manager in the area there to take care of it. And so what it does is it suddenly becomes more of a mailbox, kind of a passive income, instead of a part-time job that you think of as taking care of real estate. In fact, if there's ever a problem with the property, you never get the call. The property manager gets the call and manages that client on a day-to-day. Let me show you a couple of examples. Okay, here's one, a condo complex in Florida. The builder tried to make 47 units, but he ran out of money, and the bank took it back, and there were 16 unfinished. So these guys go in and buy those 16 of them. And, sometimes it's 3 beds, 2 baths. Sometimes it's 1 bed, 1 bath in this complex, Valley High. But here's some pictures of what it looked like. Nice pool. Of course, the interior, brand new. It's just getting finished right now for sale the first time. So there's a picture of what the bedroom looks like, what the kitchen looks like. Let's take a look at what the numbers look like on something like this. We could purchase one of these properties for $60,000. And it's interesting that we could actually do it with almost $30,000 cash in. They have a lender that will do a $30,000, what's called a non-recourse loan, that you don't have to qualify for. If you want it, there it is. So we're able to secure this property with $30,000 after paying the taxes, the insurance, the homeowners association dues, all the things. It nets in, back to the buyer $350 a month. And on that amount of cash in, that's about 14% cash on cash return. Now, that's a great solid return. That's tangible ownership on a great real estate property. Here's another property example in Memphis, Tennessee. Here's a nice single family home in a nice middle class type of a neighborhood. The purchase price was $70,000. They had that same non-recourse financing for $33,000. So one of our clients secured this for $37,000. They were able to get their non-recourse loan at 7%. And so, again, after paying property managers, taxes, and insurance, the net income, $6,500 on $37,000 invested. That's a cash-on-cash return, 17.5, almost 18%. And so when I was showing you that number on the Rule of 72, there was a reason, is we can have people's money doubling with it being held in a very safe asset class where there's tangible ownership and cash, of course, every month hitting the mailbox. Well, the second of our core 4 is trust deeds or non-recourse lending. So these are private mortgage loans that our clients make. So take, for instance, that top property, Viewpoint, which is in Ellenwood, which is a suburb of Atlanta, Georgia. It's nice, low crime there. And our trust deed investment is about 8% return, and it's secured on a single family home or a duplex. And what happens is the buyer of the property brings 50% of the purchase price. Our trust deed lenders put up 50% themselves. And so this is a 3 to 5 year kind of a renewable loan. And the interest, of course, is paid monthly. And so our lenders are in a really good position because the buyer is very motivated to make the payments because they've got half of their money down. And then our people, of course, can get a nice solid 8% return. Whether there's a tenant in place or not, the payment is due. And if there's ever a default, all they do is file a deed in lieu and an assignment of the rents, and the property becomes our lenders then the very next month. So they get rid of all the hassle and runaround that comes from foreclosing on something like that. So we have our people in a very solid, safe place generating great returns. Here's a little bit more about it. They generally will purchase these notes at a discount. this is a 5-year note. Now, that means that they're going to get their interest payment every single month, but they pay 10% less for the note than what the face amount says. So what that means is they actually get a $20,000 note, but they'll have to pay $18,000 for the note, and they get their 8% or 8% on $20,000 for 5 years. And then at the end of 5 years, they get back their $20,000. So it's a really nice way to earn a great rate of return. Another one of the lending asset classes we have is hard money. This is an opportunity for people to get anywhere from 4 to 10%. And we pool money there, and people have an opportunity to lend out on a bed and breakfast like there at the top or down at the bottom, a home that's under construction but ran out of financing. The construction loan ran out and they've got to finish it off. And so these are short-term funds that are secured by real estate, and we can pay that interest out quarterly or annually depending on how they like to have it. Our third solid asset class is structured settlements. Structured settlements are, we've got people who are maybe lottery winners or who won a personal injury lawsuit. And so we've got an insurance company paying back the winner of the lawsuit, or someone who has just a settlement from perhaps from their retirement. And so these are people who have monthly cash flow but have current needs that their $800 a month or $1,000 a month doesn't solve. And so they'll trade their monthly stream of income for a lump sum of money right now. These generally yield in the 5 to 8% range, but again are so steady. These are as steady as the U.S. government or a massive company like New York Life or Allstate. That money is going to be coming in. And so it could be paid out monthly or annually. And some of these payment streams begin right now. Some begin in the future. If they start a little bit further out right now, our money has some time to compound and gets better rates of return. But what we want to know in this kind of an investment is the strength of the payer, of the person who's going to pay back. And most of us kind of can gauge the strength of the U.S. government. So if I was buying a U.S. Navy pension, I have a pretty good understanding that that pension is going to be paid every single month. But when it's coming from a life insurance company on an annuity, I don't really know. And so there's ratings companies that tell us kind of the strength of these companies. And for instance, here's New York Life's ratings, very strong. AA plus, triple A. A plus plus superior with AM Best. And so these guys give us a real solid feel for how likely it is for us to continue to receive these payments. Well, the fourth asset class that we really like is precious metals. And this isn't to go out and speculate on what the prices might do in the future. This is all about maintaining the value of this portion of our portfolio. And gold and silver has always been a storehouse of value. And the reason is it's not just someone printing some more paper money. In order to have gold, someone had to go out and find it, and it had to be mined, and it had to be smelted, and then it had to be minted and poured out into one of these little gold bars or a little coin. So there is work to make that happen. And so gold always has a value. In fact, if you look at the chart, gold is the only thing that stayed even with the cost of a barrel of oil. If you look at the blue line, that's what the British pound did against oil. The green line, what did the US dollar do against oil? It's only gold that stays very firm. And so this is something that we buy and hold just to make sure that we keep a portion of our purchasing power there. So over time, this is not an investment where we buy and sell. This is something that we buy and hold, and this is what the wealthy do. Gold can be purchased as small as 1 gram, which is about the size of your pinky fingernail. And so if it ever came to the time where our economy went super crazy and dollars weren't worth anything, you could pull out a small piece of gold and go buy something of value. Or a tenth of a gram of silver is about $5. And so people could take that and go buy a loaf of bread or something if the economy really went crazy. Well, here's another example of gold being a storehouse of value. And this is over time. An ounce of gold has always bought a fine suit of clothes. Going back to ancient Rome, an ounce of gold bought a really nice tunic and some brand new leather sandals. Dropping ahead back to 100 years ago right now, an ounce of gold still bought a brand new suit, shirt and tie, hat, and shoes. In fact, if we look at the cost of gold currently, it's still going to be an ounce of gold. It's going to buy what we need. Today, I think gold was around $1,600. Today, I can buy a beautiful custom suit, a shirt and a tie, a new hat, and some nice high-end dress shoes. It'd still be the cost of that ounce of gold. So again, we'd buy it to hold value. Let's look at silver and what it did. Back in 1960, we were still putting silver in our coins. And in 1960, a 1960 quarter had 5.6 grams of silver inside of it. Well, sadly, today we don't have any silver in our coins. And it's no surprise that a quarter doesn't even buy anything. I was at the airport and left my cell phone at home, and I was trying to call my wife to get her to bring it out to me. And I couldn't even make a phone call with one quarter. I had to go break a dollar. So it's interesting, of course, it doesn't buy even a gallon of gas, but it is interesting that if we had 5.6 grams of silver today, it would buy a gallon of gas. And so again, silver and gold, they're a storehouse of value that we can trade for a commodity or something that we want of value if the economy really goes south. Well, what we do is we help people understand, how we should create an account for them. How much should we put in each of our asset classes? Because we can't have all of the eggs in one basket. And so we have a questionnaire that helps us understand and it suggests a balance of the core four asset classes and how we might spread that money around. And so, the stock market's been doing this for a long, long time. The downside with their diversification, though, is every single thing is still on Wall Street. They'll tell you to take aggressive growth funds and some blue chip growth funds and some emerging markets funds, but these are all funds. So what about the stuff that's not in the market? And we'd like to talk about those non-market assets and help people truly diversify and pull some of their money away from Wall Street. Maybe you feel like pulling it all off. If you do, I've got some good alternatives for you. But we want to, again, offset inflation with gold and real estate because those are the best assets to offset inflation. Real estate in an inflationary time, you just raise your rents and of course, value of your property goes up because there's more dollars chasing. Gold holds firm. We want to create monthly dividends with, again, real estate. We want those rents flowing in with our mortgages and those mortgage payments flowing in, and then pension factoring. Again, cash into our bank account every single month. And so as we take a look at what a nice, solid, ideal portfolio might look like using alternative assets, what if, and you tell me if you could retire if it looked like this, if you had, 4 single family homes paid for, rentals, all kicking out $800 a month, that's $3,200 every month hitting your mailbox. If you had 4 of these private mortgage notes, again, secured on a rental property, each paying you $300, that's $1,200. So that's now we're at $4,400. And then what if we had, if we purchased a pension from the Pentagon, a retired Navy at $500 a month, and then purchased an annuity that was flowing from New York Life, another $500 a month. That's $5,400 of cash hitting your mailbox every single month. And so, of course, it creates a big pile of cash. And what we can do is set up an automatic purchase program with one of our precious metals mints, and you can convert some of that cash into precious metals if you so desire. You could take those dollars and pay down the non-recourse loans on there. I mean, whatever you want to do. But I'll tell you what, if you've got $5,400 coming in, you can have a retirement quality of life. And we can do that on a lot less principal starting out today than what you think. Well, I mentioned that we help people understand what kind of allocation that they should have with their dollars. Where should we spread their basket? Where should we put the eggs in what kind of baskets? And we've got kind of 4 different basket allocations. Here's assertive, which is our most aggressive. It suggests 45% in real estate, 20% in that non-recourse lending, 10% in structured settlements, 15% in the hard money, and 10% in gold and silver. And then, of course, you can pick and choose what you like, and then we'll help you, obtain those assets and set yourself up to have that kind of cash flow flowing into your long-term savings program, whether it's retirement like IRA or 401k, or whether it's just non-qualified money. We can help you with that. Well, one of the things that we do is we help people with what's called a self-directed IRA. This is the tool that jailbreaks the dollars away from Wall Street and lets you use these just retirement dollars to put them anywhere you want pretty much. And what this does is hands over the controls to us. Reason is nobody cares more about our money except us. and we need to take control. But what it does is it opens up countless investment options. The IRS doesn't say everything we can do, but they do say what you can't do. And it's simple. You can't do life insurance product on yourself, and you can't do collectibles like paintings, wine, and cars. Okay, but the rest of the stuff you can pretty much buy according to the IRS using those retirement dollars. And so we do these self-directed programs that give people access to the funds. And we can hold those in two different kinds of self-directed accounts. One is called a custodian account. The other is called the checkbook account, and both of them have their pros and their cons. Let's talk about them. A custodial account is much like a savings account at the bank. The custodian holds on to your money. If you want the money to move or go anywhere, you call them and you make a request. They send the money only at your request. Now, of course, they charge you some money to do that, and there's a long waiting line to get that money out of there. Another thing that custodians do is they have a set of rules that is a higher standard than what the IRS has. And maybe they won't let you buy that real estate property you want to buy. It kind of becomes a mother may I. Mother, may I invest in this? Mother, may I invest in that? And it has kind of a delayed access to funds. And the worst situation I saw is somebody was trying to buy a piece of rental real estate. And it took 6 weeks for the money to come out of the custodian. Now, it doesn't happen all the time, but just know there's lots of people making requests and you're just in line trying to make it happen. And that's kind of tough when you're trying to buy something that is really time sensitive, like a real estate contract. In fact, if you're going to go buy a foreclosure at the courthouse steps, you're not going to be able to use a custodian account. These have transaction fees, as I mentioned. They also have asset value fees based on how big your account is, and there'll be an annual fee to keep the thing open, much like what you're already paying right now, to Fidelity or to Charles Schwab or wherever your money is. Let's also look at the other option, which is a checkbook account or checkbook control in an IRA LLC. What this does is this gives us access to our retirement dollars just by writing a check. In fact, if you have a Wells Fargo business account, it's going to be just like that Wells Fargo business account. But what this does is it gives us lower annual fees. In fact, the only fee is an annual fee paid back to the custodian, which is $150 a year. So much less. You can make any deal as fast as you can write a check, and you can do any deal that the IRS allows. And so, we give good guidance into what you can and can't do. And we, of course, our IRA LLC provider also has lifetime support. So if you have a question on what you can buy, of course, they'll take care of you. But, either one, we have options for both. In fact, we do have options for people where we will, for a percentage, we can just manage all of the alternative assets and take care of them for you and provide a quarterly accounting to you. Well, our provider for our self-directed IRAs is the best in the nation. We use Asset Exchange Strategies out of Austin, Texas. These guys are known as the industry knowledge leader. They've been in business for over 12 years. They have been quoted in the Wall Street Journal. They've been mentioned in the Business Week, in Kiplinger's Personal Finance, and in Forbes magazine. They've helped somewhere between 4,500 and 5,000 clients over 12 years. They are A+ with the BBB, never had a complaint. 5,000 clients and no complaints. But to me, the most impressive thing about Asset Exchange Strategies is they've moved over $2 billion away from the Wall Street casino into Main Street control kind of alternative assets. That is a big deal. That is experience. And that's what we want to tap into. These guys have also passed over 50 tax audits. So people with these kind of accounts have been audited, never had a problem. Of course, they've earned numerous industry awards, and you can see some of them. In fact, they just awarded 4 years running the Best of Austin, Texas. They won again 3 years running, 5-star wealth managers. They're, of course, top financial advisors. These guys know what they're doing. They know how to take care of people, and they know how to keep people on the right track to make sure they don't fall into any of the pitfalls that have to do with self-directed IRAs. Well, as we move into this, as we transition away, I'd like to go over just a little bit about what we get paid as planners to go out and tell this story. Can you tell this story? Chances are you've never heard anything like this. You've never heard that you could have your assets anywhere besides the stock market. And likely you know others that need to hear about it too. And do you need to create another income stream? There's lots of saggy budgets out there. Create some money back in there to take care of somebody who was laid off or had to drop back some hours. Well, how do we earn money doing this? We get information into people's hands. We send out a report called The Big Ugly Secret your IRA or 401k brokerage doesn't want you to hear. What it does is it begins people thinking. It lets us open dialogue and start talking about what is going on. We've got other informational pieces that we get in people's hands. We want to teach people about what's going on and create interest, and then sit down and show them what we can do. Well, what do our planners make for telling this story? They make great money to do the right thing for our clients. If they need to set up a self-directed IRA, that's what we do. If they're not using retirement dollars, we can just help them buy the asset classes. But our beginning planners make about $2,100 on an average transaction. Again, it's great money for doing the right thing for people. Our field supervisors, which is our best guys, make about $4,000 on that same kind of transaction. So come in and do one or two a month, or you do one or two a week, whatever you want to do. We've got opportunities here if this resonates with you. Our industry pays a premium for leadership. And if you're an agency builder, come here and build a dynasty. We'll pay you well for sharing your skills and talents and helping us build and grow a team all across the country telling this story. We'll pay you for your training and motivation. We'll pay you overrides. We'll pay you commissions. We've got a very powerful royalty program that we'll talk about. Well, here's an income example because a lot of people want to kind of know what it looks like. And this is our field supervisor. Our field supervisor's office receives that 80% commission. And they also sign what we call our franchise agreement with us. Our company is what we call a franchise hybrid. And so if this field supervisor went out and did 2 personal deals that month, they'd make $8,000 from their own pen. Now, we also motivate and help them go out and bring in some new planners to go out and tell the story. So if this field supervisor went out and brought in 2 brand new people, each of them receive 50% of the commission, even though the field supervisor does most of the work. The new guy probably sets the appointment, and the field supervisor goes out, does the presenting, helps them pick and choose where the assets are going to go. But of course, the new planner is earning while they're learning. Well, the field supervisor, because he does that money, makes a $1,500 commission split with that new guy. And so if each of those guys did a new one, that adds $3,000 to that income. That takes that up to about $11,000 a year, or $140,000 a year, $11,000 a month, $141,000 a year. Not bad income for doing just a little bit of work. Well, in our system, we pay our reps based on their experience and their knowledge level. And as they have some experience and they grow, we're going to increase their commissions. As our 50 guys move to 60 and they go out and have some people that want to share the story with them, well, there's an override between the difference of the contract at 50 and 60. And then, of course, the 60 guy is starting to do a little bit more of the work, less to the field supervisor because he's doing less of the work. Then his override goes to $1,000 on each transaction. And so if each of those guys do 3, then that's $3,000 more to the field supervisor. And if he has a couple of guys in that situation, that brings his personal income up to about $17,000 a month. And again, this is running a really small agency, but about $200,000 a year. People can live pretty well on that kind of an income right now. And again, we're not doing a ton of volume. We're just out telling the story, making this thing happen, and building a very solid income base. Well, one of the things about the financial industry, and I've been in the financial industry for 18 years now, that's been very frustrating. I see it in real estate. I see it in mortgage lending. I see it in insurance. I see it in all kinds of businesses where people basically hire and train their own competition. And we did not want anything to be like that. We wanted our field supervisors to be compensated for building the strongest and best agents that they have. We didn't want them to hold back their best script or how to resolve concerns or use their hold back their best marketing. We wanted them to share everything. And subsequently, when the 60% guy there becomes good enough to get the 80% contract or become the field supervisor, we want them to have that contract. And so we have a royalty program that pays the promoting field supervisor a 8% royalty on all the sales volume of his promoted field supervisor for the rest of the life. And so if that field supervisor that got promoted that was just as good as the original guy went out and still did about 10 deals, that same type of volume, that 8% royalty would pay $4,400 additional income to that field supervisor. paid forever. So now that $4,400 brings that monthly income up to $21,400. We also, of course, want to give the guy that's in that field supervisor's office the same opportunity. And when he promotes to field supervisor, we'll pay 8% royalty to the promoting field supervisor, and we've got a 6% royalty to the second generation field supervisor. So again, same kind of volume, $3,300. We also pay a 4% royalty on the third generation, and we pay a 2% royalty on the fourth generation. And so, we want to keep our original field supervisor engaged, training, motivating, and helping strengthen and build each of these field supervisors. And so we've got some income attached to their success. So again, without selling and recruiting and building the entire planet or whole county, we've got a really strong ongoing income here as we build through our royalty program. Well, the question becomes, how do you want to be involved? Are you interested in learning more about diversifying some of your portfolio into alternative assets? If that's the case, please get back with whoever got you in front of this information and just talk to them. Let's ask some questions and see if there's some things we can do to help. Maybe you have some interest in just doing personal sales and going out and telling this story, maybe filling up rooms and doing some seminars and sharing this information, shouting it from the rooftops, because again, people need to hear this. There is a stock market is not looking good. Well, personal production and agency building. Maybe you want to go out and sell, but you also want to help build an agency and take care of that American dream and build you, that royalty program and some overrides and some incomes. We can help you on all three of those interest levels. If you do want to come on with us and help us grow the story, what we need you to get is an in-business kit. This is the tools for the trade that allow you to go out and do this thing. We've got a portfolio that helps you look, really professional, that's branded with us. We've got the asset allocation guide that, helps your clients make some decisions about how we should put their eggs in which baskets. We've got brochures that you need, all 10 of each of the brochures you need to get going. We've got a couple of $100 vouchers towards the purchase of a self-directed IRA. You can use them yourself. You can use them on your first, client appointment. The reason we've got 2 in there is you can use one for yourself, and then it gives you motivation to go out and give it away to somebody and, get you in front of them and get them to talk. Of course, we've got some company branded, pens and keychains. We've got the training that you need. We buy you your first set of 250 business cards. And then as a gift from me, the greatest financial planning book ever, The Richest Man in Babylon. It's fantastic. But to get enrolled with us, there is a one-time cost. And I didn't talk also, we include a replicated website that is assigned just to you. And that's, again, just all covered in the one-time cost of $139. FedEx Ground charges us about $11 to bring that out to you. So our enrollment fee is $150. It is not ongoing. Let me close with this. Defeat the enemy to your success. What is that enemy? And that is procrastination. If you have any interest in what we're talking about right now, get back to the person who told you about this, because the worst thing that can happen is you thinking about it. Maybe I'll talk to him tomorrow. It's needlessly avoiding making a decision when the opportunity arises, because what happens is you cool off and then you'll never get back to the person. So get back to the person who told you about the information and start asking some questions and get everything taken care of, because we'd love to be working with you. If you can see yourself doing this, let's get you started telling the story. Well, that's all that I have. Let me see if there's any questions that have come in. All right, there are no questions at this point. I hope I've given you a fair representation of what we do here at Main Street Alternative Asset Planners. And I would, again, please feel free to get back with the person who put you on the call and get any questions, answers that you might have. We'd love to have you tell the story and earn a great living doing it. Thanks so much. Have a great evening.